Choosing the right mid-cap fund in India? Yeah, it can feel like you're searching for a needle in a haystack. There are just so many options. So today, we are going to cut right through all that noise. I'm going to give you a simple but really powerful framework to help you decide with total confidence. Let's just dive right in. It's the big question, right? The one every single investor asks themselves. You've got hundreds of funds out there. They're all screaming, they're the best. So where do you even begin? It's a lot. But what if the answer was actually a lot more straightforward than you think?
And you know what? Let's just bust a huge myth right off the bat. The biggest mistake people make is just chasing last year's #1 performer. The real key is finding the fund that actually aligns with your goals and your comfort with risk. And to do that, we have to look a little deeper.
So why are we zooming in on mid-caps today? Well, it's because they hold this really unique, strategic, and frankly, powerful position in any investor's portfolio. First things first, a quick definition so we're all on the same page. In the Indian market, we're talking about companies that are big enough to be pretty stable, but they're still small enough to have a ton of room to grow. They're not the giants, they're not the tiny startups, they're right there in the middle.
And this table just lays it out perfectly. Large caps, they're your stable, steady giants, but a bit slower. Small caps, man, they can be explosive, but they're also super risky. Mid caps aim to give you the best of both worlds. That really high growth potential, but with a lot more stability than their smaller cousins. It's the sweet spot.
Okay, so to unlock the real potential in this category, you absolutely need a reliable method. So we've broken it down into a powerful two-part framework. I want you to think of it like having two different keys that you need to make one confident decision.
And this right here, this is the core idea. The best analysis is never just one-sided. You need the numbers, the data to tell you what happened, and then you need the narrative, the story, to tell you why it happened.
So here's the game plan. We start with the first key, the cold, hard data. This is how we create a short list of really strong contenders. Then we use the second key, which is the story behind the fund, to figure out if that past success is something they can actually repeat, and most importantly, if it's the right fit for you.
All right, it's time to pull out that first key. We are diving into the data to see what the numbers are really telling us about a fund's performance and its risk.
Now, we're not going to get lost in the spreadsheet. Don't worry. We're going to focus on 4 key numbers. First, CAGR. That shows you the true long-term performance. Second, standard deviation. That tells us how bumpy the ride is. Then, the expense ratio, basically what it costs you. And finally, the turnover ratio, which gives us a little hint about the manager's strategy.
Let's start with a wow number, just to see why this is so important. A 5-year CAGR of over 35%. That is just exceptional. See, this isn't just a one-year fluke. This shows sustained, powerful growth over a really meaningful amount of time. So the lesson here is always look at long-term compounded returns.
But, high returns can sometimes mean a pretty wild ride, and that's exactly where standard deviation comes in. It's just a simple measure of risk. The lower this number is, the smoother the journey is going to be for you, the investor.
And this chart just illustrates that point perfectly. Look at the HDFC Mid-Cap Fund. Its standard deviation is actually lower than the category average. What does that mean? It means it has historically delivered its strong returns with less volatility than its peers. And that is a very, very desirable trait.
So, we've filtered with the numbers. Now it's time for our second key, and you could argue this one's even more important. We need to understand the story, the why behind the performance. Was it just skill, or was it just dumb luck?
So, we're going to look at 3 things: the actual person managing your money, their guiding philosophy, and how they go about building a portfolio. These are the human, strategic elements that are going to determine if that success can actually be repeated down the road.
A fund's philosophy can often be summed up in just a simple phrase: buy right, sit tight. That immediately tells you everything. This fund house believes in doing deep research to find great companies and then just holding on to them for the long haul. It's a huge indicator of their entire strategy.
So how do they actually put that philosophy into action? Well, it usually comes down to 2 main approaches. A concentrated strategy makes these big, high-conviction bets on just a few stocks for potentially huge returns. A diversified one, on the other hand, spreads the risk for more stability. Look, neither one is better. It's all about what matches your comfort level with risk.
Okay, theory time is over. Let's put this whole framework to work. We are going to analyze 3 real-world mid-cap funds, and each one has a very different story to tell.
First up, Motilal Oswal. I want you to think of this fund as the Sprinter. It is built for raw speed and high performance, and it takes that high-conviction approach to try and win big.
And the numbers totally back up that Sprinter story. An incredible 35.44% 5-year return. But it comes with higher than average risk. Its strategy is that buy right, sit tight philosophy inside a very concentrated portfolio. This fund is really for an investor who's comfortable taking on more risk for the chance of those higher rewards.
Next up is HDFC Midcap. Okay, if Motilal is our sprinter, think of HDFC as the steady marathoner. It's focused on consistency, on stability, and on finishing the long race strong. The numbers here tell a story of stability. You've got great returns, but with that lower-than-average volatility we saw earlier. And the story behind it, the qualitative part, it's even more compelling. It has been managed by the same person, Chirag Setalvad, since the day it started. That kind of consistency and leadership is incredibly rare and so valuable.
And finally, we've got the Nippon India Growth Fund. This is the seasoned veteran of the group. This fund has seen it all, and it has a long, proven track record to back it up.
Its key feature is just pure longevity. It was launched way back in 1995, so its process has been tested through market booms and busts. It delivers consistent return through a really research-heavy approach, which makes it a super reliable choice for that long-term investor.
So we've analyzed the funds. Now, how do you actually take all this and build it into your own long-term plan? Let's zoom back out for some final principles for success.
Okay, 3 final actions for you. First, use a systematic investment plan, or an SIP. Investing a fixed amount regularly helps average out your purchase price, which really smooths out the bumps in a volatile category like mid-caps. Second, just be aware of the taxes on your gains. And third, and this is the most important one, stay disciplined. Tune out the daily market noise and just stick to your plan.
And listen, this part is non-negotiable. To truly get the benefit of the growth potential in mid-caps and to ride out those inevitable ups and downs, you have to have a long-term mindset. We are talking a minimum of 5 years and ideally closer to 10 years.
So there you have it. You now have the framework, the 2 keys to unlock confident decision-making. You've got the numbers, and you know how to read the stories. So the final question isn't, which fund is the best? It's which fund's story is the right one for your financial journey.
If you like the content, please like and subscribe. Comment on Finance Seco India.